It's a great month, a lot of things going on. Let's run through the headlines. COVID-19 Delta variant update.
Vaccines are effective. In the US, over 90% of the 65 and older population has been vaccinated. Therefore, lockdowns should not be necessary. Lockdowns were to prevent overwhelming the healthcare system, and it appears as though the US, economies like the UK, have broken the link between cases, hospitalizations, and deaths. Lockdown should not be necessary in the US, and Delta should not derail the economic recovery.
China, crackdown, markets have been in the tank.
Legitimate questions: are Chinese stocks uninvestable? Our view is no, they are not. The actions that the Chinese Communist Party has been taking, the new regulations they've been issuing, have been in line with their long-term plans, which have been communicated in advance. We don't see things like Chinese stocks getting delisted en masse from U.S. exchanges, and a lot of this volatility creates opportunity for active managers, especially those that can buy stocks on local exchanges.
On the U.S. front, we had a recession. At least they tell us we had a recession.
Yeah.
We were about to have a depression, and now we only had a recession, maybe the shortest recession ever.
Yeah. National Bureau of Economic Research came out and said the recession from COVID only lasted 2 months. It was March and April 2020. They announced it in July, that it was only 2 months. And with the Q2 2021 GDP advance estimate, GDP is now back above pre-pandemic levels, back above its long-term trend. So very much fits the narrative of this was more of a natural disaster type recession, the shortest recession in US history.
No recessions ever again. Corporate earnings, as we suspected, they're crushing it.
Earnings yields are going up because the earnings growth has been so strong. Stocks just looking increasingly attractive relative to bonds.
Stock buyback starting up.
Exactly.
It's as if nothing ever happened. Interest rates, kind of a conundrum.
Yeah.
We would expect them to be higher. They've been trending lower.
Yep. 10-year Treasury yield at 1.25%, 1.3%. Very low, very inconsistent with all of the economic data and inflation data points we're seeing. A lot of it is due to technical factors related to a lack of Treasury issuance recently. Those factors should start abating and potentially rolling over. And we think by the end of the year, the 10-year Treasury yield should move back up. That creates a lot of opportunities within the equity market, particularly in value stocks and small caps.
So let's get started with the monthly returns.
Take a look at asset class returns. The column furthest to the left are returns just for the month of July. So the S&P 500 up during the month. It was primarily driven by large cap growth stocks. Those were the big winners. The S&P 500 hitting new all-time highs quite frequently during the month of July. Small caps, you can see down a little over 3.5%. Started underperforming really in the late May time period and continued to struggle for the first half of July. Rallied a little bit towards the end, but they were down for the month. And then in foreign equity, foreign developed markets slightly positive, emerging markets down significantly, so down over 6.5%. But digging under the hood there, over a third of the MSCI emerging markets index is just China. And China was down about 14%. So that negative return was pretty much all China. So we'll definitely dig into that. And then interest rates continued to move lower and really stayed low throughout most of the month. So some positive returns in the fixed income space, and real assets still doing well. Anything inflation sensitive just continues to do well. So,
what do you make of the large cap, small cap divergence here for the month?
Yeah. A lot of it appears to be technical. A lot of it appears to be based on what's going on in the bond market. So, when we think about the underperformance here recently of small caps and value stocks, it doesn't seem fundamental, just like how low interest rates are doesn't seem fundamental. So that's definitely something we'll dig into.
I guess the other end of the spectrum is interest rates. With inflation ripping, right?
Yeah.
Definitely trending. We would expect higher rates.
Yeah. Put quite simply, if you were to take the 10-year Treasury yield right now, 1.25, thereabouts, and you strip out core inflation, you get the lowest inflation-adjusted bond yield since the 80s. Very unattractive time
Right.
to own bonds at these yields.
All right, let's look at China. And to our point here on the screen of what's going on in China.
Yeah, China. So these various lines on the page, these are representing different baskets of Chinese stocks or individual Chinese stocks. And, we talked about how in July the China MSCI EM index down a lot, China down a lot. We can take each of these lines one by one because there's a story in each one of them. But broadly, what you're seeing here is these are bellwethers of Chinese stocks, most of which listed on U.S. exchanges, that are down anywhere from 25 to 88% year to date.
Yeah.
And that's after a lot of them being up 40% in the first month or so of the year.
Yeah.
So just a dramatic reversal. And all of these individual stories, in our view, are closely related to the fact that, China is going to do what is best for China, and they are acting in line with their long-term strategic initiatives. And they really have little regard for, foreign investors and stocks. They're just casualties. China's going to do what's best for China. And that's really what's happening here with all these stories. So.
But recently they've come out and said they'll be very supportive and provide more stimulus, correct?
Right. Yeah. That's so. For example, just this past week, China came out and announced that they are going to basically regulate away all profits for the after-school tutoring companies in China. This is a huge market. New Oriental Education Group, that's the green line on the chart, TAL Education Group, a number of other ones that have lots of overseas investors investing in these stocks. These are great businesses. And, to basically overnight to have the Chinese government regulate away the profits, many investors outside of China are raising the question, are Chinese stocks even investable at this point? Should we be putting our money there? I mean, to think overnight, just say, oh no, you can't make money anymore, that's very difficult. And it's in line with their broader initiative to reduce social inequality and increase the birth rate. It's loosely related to that.
All right.
But then you see, a week after, the Chinese security regulator puts together a conference call with all the big investment banks and money managers in the U.S. to try to say, hey, this is an isolated incident. You don't need to pull money out of Tencent and Alibaba and all this. And it goes back to what happened in 2016, the first time they reset the yuan lower.
Right.
Lack of communication just happened overnight. Not used to that. As sort of Western investors,
doesn't happen
used to better communication. And they're just kind of, they're kind of working through it. And it's a very high stakes game of them learning how to make these regulatory changes and how to notify other people. And you have to wonder if they even want to play nice or care.
So let's just move on to the update on our outlook, because we have been setting new all-time highs quite frequently. And the equity trend is still higher. Commodity trend is still higher. So let's give an update on our investment outlook, back to the future scenarios.
Yeah, the bull case scenario we spoke to quite a bit, how that, in our views, is probably about a 50% probability, maybe more, saying that with 7 months of hindsight, obviously. So the 1.21 gigawatts of money at 10:04 p.m. If you look down at the price targets and you compare those to where we're at currently in the market, you could make a case that, hey, the bull case is priced in. Pack it in, go to cash or whatever. We don't do that. There's always another inning. The game is never over, right?
Right.
And then also to note that, you go down this line item, U.S. GDP growth for the full year, 7.5. Well, consensus now is 7. So the market has moved towards that. Inflation, 3.5% on core. We're there. Inflation's been running hot. Fed assets, $8.5 trillion. They'll get there by the end of the year. No problem at all. The 10-year yield at 2%. It's
the only one.
Right. That's the only thing that's inconsistent. We're at around 125, 130.
Yeah.
So that doesn't seem to make sense with everything else that the market is pricing in here. And then the S&P 500 at 4,400. We're there. So, two legitimate questions. Why is the 10-year yield not consistent with everything else that we've drawn out here? We think we talked about that. We think by the end of the year, it will be closer to 2% for sure. And then the other thing is, well, you've reached your S&P 500 price target. Where are the returns going to come from here for the rest of the year? And it comes into the type of equities that clients own. The S&P 500 could stay around 4,400 for the rest of the year, but smaller cap, more value-oriented equities, the companies that are posting the strongest earnings growth right now, as the Treasury yield curve steepens again, the 10-year yield comes up, we think it most likely will, those types of stocks have plenty of room to run. So that, in our view, is where the returns will likely come from, and there's still positive return outlook through the end of the year.
Great. Well, that's probably enough for this monthly update. I'll look forward to seeing everyone next week. Thanks, Mike. Thanks to our research team for all these great slides. And as always, if you have questions, let us know, and we'll talk to you next month.
Thank you.